The odds of an economic recession, if not depression, have skyrocketed to 99%. I'm going to reveal why in one simple, fast step. Let's get right into it and go over the world's most powerful economic indicator. And make sure you stay to the end of this video because I'm going to show you exactly what I am doing in my own portfolio to position myself for this 99% probability that we go into a recession in 2023. But getting back to this indicator, you say, George, there's not much on your whiteboard there. What exactly are you talking about? We're going to get into that in just a moment. But before we do, let's go back in time and see how this powerful economic indicator has worked in the past. We go back to 1955. It predicted a recession and indicated by this little red line here, we got one. 59, same thing. 65, it predicted a recession, but we did not see one within the next year or two. More on that in just a moment. 1969, 74, 80, 81, 89, 99, 07, and 2019. So the quick math here is it's predicted 10 of the last 10 recessions. An incredible track record going all the way back to 1955. It would have 100% accuracy if not for 1965. And hopefully you can tell already in the video, this is a very, very important date. So what are we talking about specifically, and what is it telling us about what we'll see in 2023? Editor, go ahead and help me out with this one. It is the spread between the 10-year Treasury and the 1-year Treasury. So when the yield on the 1-year Treasury goes higher than the 10-year Treasury, in other words, the curve inverts, that's when you know the economy has big, big problems. So then the question becomes, okay, George, what does this spread look like today in 2022? Well, we go to the end of the chart and you can see that now the 1-year Treasury is over 1%, 100 basis points plus higher than the 10-year Treasury. And going back to 1955, this is predicted 100% of the recessions we have had in the United States. In other words, we have never had a recession without the inversion of the 10-year and the 1-year Treasury. And right now, that delta between the two yields is more extreme than it was in 89-90, 99-2000, 07, and 2019. Just so you got your head around how this works, let's go below the chart and look at today's yield curve. So today is November, was it the 22nd, 23rd, something like that, of 2022. The 1 month today, or the last time I checked, was trading at 3.85%. Okay, 3 month, 4.31, 1 year, 4.74, 2 year, notice it starts to go down. More on that in just a moment. 4.47. Now we go all the way out to the 10-year, 3.68. Notice, guys, the 10-year Treasury is trading not just below the 1 year, it's trading below the 3 month, the 1 month. And it doesn't stop there. If we look at the current Fed funds rate, that's the overnight rate the Federal Reserve pays the banksters for holding bank reserves at the Fed. Their rate is 3.9. And unfortunately, when you look deeper, it gets even worse. Look at this. Reverse repo. This is the interest rate the Fed pays money market funds, as an example, for parking their cash or their bank reserves at the Fed. And the reason they set up this rate is to set a floor on interest rates for the entire economy. Right now, reverse repo, or the last time I checked, was 3.8%. And look at this. The 10-year Treasury is trading at 3.68. Not to mention the 30-year Treasury is trading at 3.72. So the 30-year Treasury is trading not only under Fed funds, but under reverse repo, which is supposed to be the lowest rate in the entire economy. And right about now, your friend and family member Fred is chiming in and saying, "Oh, George, you don't know what you're talking about. There's not a 99% chance that we see an economic recession or depression in 2023. Just look at your own chart. Remember, 1965, the yield on the 1-year Treasury was higher than the 10-year Treasury, and nothing happened then. How do you know we won't see the exact same thing in 2023? Well, what I would tell your friend and family member Fred that's always calling you a fearmonger, a conspiracy theorist, or a tinfoil hatter, I'd say, yes, you are right. In 1965, we did not have a recession. But I'd like to point out that GDP went from 10.1% all the way down to 0.2%. I didn't say 2%. I said it went from 10.1 to 0.2%. So as close as you can possibly get to a recession. In fact, think of what happened to the standard of living of the average Joe and Jane if economic growth declined by 10%. The impact on society would be identical to a recession. But right about now, your friend and family member Fred is going to say, okay, well, fine, you got me on the 1965. But right now in 2022 and 2023, it's different because we have quantitative easing. And the Fed is manipulating this entire yield curve. So any signals that it's telling us should just be completely ignored. And this is a very valid point, but I'd like to give Fred a quick warning. Editor, let's cut to the internet. I think you'll find this interesting. This is right from the website where we got the chart that you see up on the whiteboard right now. Keep in mind, this is in 2019 when the yield curve inverted in, say, September or November, right around the time when we had the repo spike. So getting back to the RBC. Despite the wonderful track record of the yield curve inversion as a recession bear market early warning, we believe the routes taken by the economy and the markets this time will undoubtedly wind up different. In other words, just like your friend and family member Fred has been telling you, it's different this time because of fill in the blank. But what we now know, looking at this in retrospect, is we had a massive recession in 2020, just like the 1-year and the 10-year yield by its inversion was predicting. My point is the most dangerous words in investing are this time it's different, regardless of whether you're in 1965, 2019, or 2022. So what am I doing in my own portfolio to position myself for a potential recession, if not economic depression, in 2023? Well, before we get there, let's go right back to the current yields on treasuries at the short end of the curve and the long end of the curve. And remember, I pointed out that currently the 2-year treasury is yielding less than the 1-year treasury. So what I want you guys to watch for in the future is this dynamic going to the left. In other words, shorter and shorter maturity. So what I mean is next, I think what you'll see is the 3-month treasury will be trading higher than the 1-year. And then it'll move to the 1-month treasury trading higher than the 3-month. And eventually, Fed funds will trade higher than the 1-month. This is just a prediction. It's something I want you to watch for, because this tells us that as this dynamic moves closer to the front of the curve, we're closer and closer to a recession, if not depression. This is the bond market telling us that we're also closer to a Fed pivot. Now let's go ahead and move on to what I'm doing in my portfolio. And you can actually find a model portfolio in Rebel Capitalist Pro. This is the online investing forum I have with my good friends Lynn Alden and Chris McIntosh. We've got a ton of other pros in there, a lot of your favorites like Brent Johnson, Patrick Ceresna, just to name a few. And you can check this out at georgegammon.com/pro. Obviously, I'm biased, but I don't think there's any better resource out there to help you prepare for what we're going to see in 2023. But with my excess cash position, I've put 10% of it in gold. As you guys know, I always put 10% of my investable assets in the yellow, shiny rock. It's not to get rich, it's to stay rich. For me, this is an insurance policy. But with the rest that I'm waiting to deploy, I've put that in short-term T-bills, such as 6-month and 1 year. Why? Because I think this bond market, like we said earlier, is telling us that the Fed pivot is going to be sooner than later. Most likely, we're going to see it at the beginning or middle of 2023. So if I buy these T-bills now at a very high interest rate, and the interest rate goes down in the future, I'll have a capital gain. And then I can go ahead and sell those T-bills, take the dry powder, the cash, and then buy something that I want to hold for the long term if the prices come down, which they most likely will if we go into, right here, a recession or economic depression. Things such as commodities. And the worst case scenario is I just hold these T-bills a very short period of time until they mature, and I get 100% of my principal back, plus the interest rate, which is a lot better than I can get right now in a checking or savings account. And to get even more insights as to what we'll most likely see in 2023, or to even ask a specific question to myself, Lynn Alden, Chris McIntosh, Brent Johnson, etc., you got to check out Rebel Capitalist Pro at georgegammon.com/pro. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.